Imagine waking up to headlines screaming, "Trade war ignites global recession." Your stocks plummeting, your home's value frozen, and jobs vanishing like smoke. What if I told you one ancient asset is surging 30% this year, shielding fortunes amid the chaos? Gold isn't just metal, it's your economic lifeboat in 2025's storm. But why are savvy investors flocking to it now? Stick around, this could save your portfolio. And let's start with the elephant in the room. Economic uncertainty fueled by tariffs and escalating trade wars. President Trump's aggressive tariff policies, imposing up to 60% on Chinese imports and 10 to 25% universally, have sparked retaliatory measures worldwide, as reported by Reuters and the Tax Foundation. These aren't just numbers, they're a $1,300 annual tax hike per US household, slashing GDP by up to 1.3% before retaliation even kicks in. JP Morgan economists warn of a 0.6-1.0% GDP hit to trading partners like Brazil, while the IMF calls it a significant risk to sluggish global growth. Picture this: supply chains disrupted, prices for everything from iPhones to steel skyrocketing. Reuters estimates a $2,300 iPhone under full tariffs. Businesses freeze hiring, consumers cut spending, and markets plunge. The Dow dropped nearly 4% in a single day amid the shock. CEPR analysis shows direct US-China trade could collapse, distorting global value chains and causing welfare losses up to 2% in the US alone. In this fog of uncertainty, echoing the 1930s Smoot-Hawley tariffs that deepened the Great Depression, gold emerges as the ultimate safe haven. Why? It's not tied to any currency or stock. It's a tangible store of value, immune to trade barriers and inflation spikes. As the dollar weakens, down to a 3-year low per CNBC, gold's allure intensifies, drawing investors fleeing volatile equities and bonds. Forbes and Investopedia highlight how gold thrives in such environments, historically rising 25% during crises like 2008. In 2025, with tariffs potentially fueling stagflation, gold isn't just smart, it's survival. Now layer on the housing market's icy stall. High interest rates, stuck at 6.7-6.9% per Freddie Mac and JP Morgan, have locked homeowners into ultra-low pandemic-era mortgages below 4%, deterring sales and slashing inventory to historic lows. Forbes reports home prices rose just 2.3% annually in May, the slowest since mid-2023, yet affordability craters. Median payments hit $2,675 monthly, up 5% year over year. The New York Times details how rates doubled since 2022, freezing the market. Existing sales down 2.7% in June. New homes at a 10-month supply glut. Redfin notes 15% of contracts fell through in June, the highest since 2017, as buyers back out amid recession fears. US News predicts flatter growth through 2030, with sales muted until rates dip below 6%. But tariffs could keep them elevated, per Wells Fargo. This housing crunch ripples. Construction jobs evaporate, consumer wealth erodes, and spending slows. Enter gold, a non-correlated asset that hedges real estate woes. As home equity freezes, gold's liquidity and inflation protection shine. Bloomberg notes it's up 30% year-to-date, while housing stagnates. Investopedia experts affirm gold's role in diversifying away from property risks, preserving value when bricks and mortar falters. The plot thickens with the latest jobs report signaling a full economic slowdown. The August Bureau of Labor Statistics data, released September 5th, shows just 22,000 jobs added, far below 75,000 forecasts, with unemployment ticking to 4.3%, highest since 2021. Revisions slashed June to a net loss of 13,000, the first since 2020, while July rose slightly to 79,000, but 3-month average hiring is a dismal 29,000. CNBC and CNN report manufacturing shed 12,000 jobs amid tariffs, federal employment down 97,000 YTD from cuts. ADP's private payrolls just 54,000 in August, half July's. Black unemployment hit 7.5%, youth at 14%. Canaries in the coal mine for recession. Reuters warns of stagflation, tepid growth, rising prices from tariffs, Wage growth slowed to 3.7%, below inflation. Real income shrinks, spending craters. The Guardian notes 85,979 layoffs in August, up 39% monthly, as hiring stalls. JOLTS openings at 7.2 million, lowest since 2021. Gold beckons. Forbes and Bloomberg emphasize its inverse correlation to job weakness. During slowdowns, gold rises as a flight to safety play, up 21% YTD amid this malaise. With Fed cuts looming, 96% odds in September per CME, gold's opportunity cost drops, supercharging gains. So why buy gold in 2025? It's simple. In this perfect storm of tariffs igniting trade wars, housing locked in ice, and jobs evaporating, gold is the unshakable anchor. Investopedia details its role as an inflation hedge and portfolio diversifier, up 30% annually in crises. Forbes predicts $3,000 plus by year-end, driven by de-dollarization and central bank hoarding, 900 tons forecast by JP Morgan. Bloomberg affirms, as tariffs fuel uncertainty, gold's safe haven status propels it to records. Physical gold ETFs like GLD or mining stocks, options abound. But act now. Reuters warns of supply squeezes from ETF inflows and Asian demand. Gold isn't just investment, it's insurance against 2025's volatility. Ready to fortify your finances? Subscribe now for more cutting-edge investment news and self-development strategies to thrive in uncertain times. Hit that bell, your next big move awaits. Invest wisely, the gold rush is on.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.